Hi, I'm Ariah Klages-Mundt.
And I'm Gudgeon. The other three authors on this paper are Dominik Harz, who is with me at Imperial College London, and Jun-You and Andreea Minca, who are both at Cornell. Today we're going to present Stablecoins 2.0, Economic Foundations and Risk-Based Models. Well, the first thing to say is that DeFi, or decentralized finance, is both growing and becoming increasingly complex. So in terms of total value locked, it's grown 20 times in 1 year, and it's becoming increasingly complex with new risks and composability. 2020 was really a year of crisis for DeFi. On Black Thursday, on the 12th of March, we saw that a crash in the price of ETH was able to trigger instability from a deleveraging spiral in DAI. This was anticipated in one of Ariah's previous papers, and this was exacerbated by various on-chain auction problems. In addition, there have been several other DeFi crises this year. There was the mempool manipulation that enabled the theft of around $8 million in Maker. We also saw Mika Zoltu's blog post on a governance attack that was possible in Maker. Various hacks as well. So BZX lost $8 million in an attack, and additionally, miners were able to trick the stablecoin protocol PegNet, netting $7 million. So we focus in this talk on stablecoins. So a stablecoin is a cryptocurrency that has added economic structure, which aims to stabilize the price or purchasing power of that coin. There have been several recent papers which explore existing stablecoins, but there are no risk-based models which manage to span the space of the possible choices and the trade-offs that are made. So with this paper, we aim to fill the gap by providing a manual for future stablecoin research. We do this firstly by decomposing the design space for stablecoins. Then we pose various fundamental design questions. We propose new models to address these questions, and then we consider the extensions to DeFi more broadly. We start with the decomposition of the design space. So we start here with a broad overview. So the first main risk-based division for stablecoins is between custodial and non-custodial. So for custodial, there is Tether as an example. Non-custodial, there's DAI. For custodial stablecoins, there are risks, such as counterparty credit risks, censorship risk, and traditional financial risks. And luckily, these are quite well understood. On the non-custodial side, there are new risks and attacks. So there are deleveraging risks, there's risk to price feeds, governance, there's existence of minor extractable value, there are smart contract bugs, and generally these are not so well understood. So on the custodian side, there are three main forms. So there's a reserve fund. So this is 100% collateralized and functions like an ETF with the creation and redemption. There is a central bank form, and you should think here of digital fiat, where currency models are relevant here. And lastly, there is also fractional reserve funds. These are similar to ETF models, but also introduce threshold risks. So a fractional reserve fund can take two forms. So one is like a bank. This introduces bank run risks, and bank run models are relevant here. Another is like a money market fund, and this tries to maintain a pegged redemption rate. So on the non-custodial side, we first highlight three functional distinctions, and we go into more detail on these in the coming slides. So firstly, we have exogenous collateral. So with exogenous collateral, the collateral asset is actually primarily used and has markets elsewhere. This is associated with deleveraging risks. Another is endogenous collateral. So this is where an asset is created for the very purpose of being collateral. This is associated with amplified deleveraging risks. Lastly, we have implicit collateral. So here, the collateral is not explicitly tokenized, and there's a different risk absorption structure. So there's no direct obligation to absorb losses. There is only an incentive to do so. The rest of the talk is focused on this non-custodial side.
Now we're going to take a deep dive into non-custodial designs. These have parallels with collateralized debt obligations, or CDOs. So imagine that we have a portfolio of underlying assets, where the value is represented with this blue bar. Now we split this into two tranches, a junior tranche, which is more risky, and a senior tranche, which is less risky. Now imagine something bad happens and a loss is incurred. This is first borne by the junior tranche, and the senior tranche is protected. Using our language of non-custodial stablecoins, a risk absorber is similar to the junior tranche, and a stablecoin holder is like the senior tranche. Additionally, in our setting, there's a deleveraging process that turns this into a perpetual protected position, where the CDO is constantly resized so that the collateral continues to provide sufficient coverage to protect the stablecoin as prices change. We've identified several functions that compose a stablecoin system. A stablecoin recipe can use any combination of these ingredients. The first one we've already connected with, a component that provides the primary value behind the stablecoin, which includes the exogenous, endogenous, and implicit collateral ideas. We've also introduced the risk absorber, which can take a few forms. Namely, equity risk absorption, where a secondary fungible position absorbs the risk, agent risk absorption, where agents can tailor their own positions, as well as other insurance mechanisms that are usually used as secondary mechanisms. These connect with issuance, which determines the stablecoin supply. This can be determined through agent-based decisions or algorithmic issuance. The deleveraging process, which we've already introduced, is also part of this. The remaining elements are stablecoin holders, a governance mechanism, price feeds which provide required inputs to the system, and miners on the base chain in the background as always.
As we have seen, there are multiple dimensions to consider, and the tree at the beginning of this presentation cannot capture the picture in all of its dimensions. So here's a visualization where we classify according to three dimensions, namely primary value on the x-axis, risk absorbers along the y-axis, and then for issuance process we put this in the color axis, and then we plot where existing projects fall. Let's briefly pull all of these parts together into a concrete example, comparing DAI with traditional commercial bank money. Maker governance is roughly parallel to the role played by a central bank, with an important distinction here being that stablecoin governance is profit optimizing, whereas we can usually assume that a central bank is stability seeking. To illustrate this, governance is not always committed to maintaining a peg. You can see Maker's recent discussion about abandoning theirs. Vaults are roughly parallel to commercial banks, with an important distinction here being that stablecoin stability depends on the joint actions of all of the participating agents. And lastly, DAI holders are roughly similar to depositors. Because of these differences, the stablecoin side requires new models, and the best we have to hope for is that protocols can be well designed and the peg maintained through incentives. We take away two fundamental design questions. Firstly, on incentive security. Is there mutually profitable continued participation across all required parties? This includes attack incentives, so rational agents may be less inclined to participate if incentives lead to profitable attacks. Secondly, on economic stability. Do the incentives actually lead to stable outcomes? Note that feedback effects can lead to the breakdown of incentives and instability. While it is possible to shift risk around to different agents, mitigating feedback effects, this necessarily makes participation less attractive to some agents, and we're back to question 1. So to address these two questions, we introduce new models. Capital structure models, which are one-period models, forking models, which are multi-period, and price dynamic models.
Capital structure models are originally a type of model to describe IPO incentives. We extend these models to understand stablecoin issuance and governance incentives within a single period. We consider three assets: a collateral asset, the stablecoin itself, and a governance token. And then three types of agents: a risk absorber, which we'll call a vault, a stablecoin holder, and an outside governor. And we'll note that there are further variations that can be done on the setup, which we discuss more in the paper. In the simplest formulation without an attack vector, the model is a game between governors and vaults. The governance problem is to decide the interest rate that maximizes revenue subject to the vault's issuance decision. And the vault's problem is to decide issuance in order to maximize expected returns from leverage, taking into account the fees that are paid to governance, and subject to a few constraints: a collateral constraint, a participation constraint compared to alternatives, and a stablecoin market pricing. And the anticipated decisions from one side feeds back into the decision of the other. We next add an attack vector, in which a fraction of governors can steal a fraction of collateral at the expense of their share of the governance token valuation, plus an outside cost to attack alpha, which would include off-chain recourse. So this resembles a flexible governance mechanism that has the power to update a stablecoin system. The governance problem changes here to incorporate an attack decision variable, and the vault problem now factors in this attack possibility in deciding participation and issuance. We can expand this a bit further to consider the context where agents can collude to restrict the exit of other agents and then indirectly steal value. As an example, DAI holders could collude to prevent the exit of vaults, since DAI debts need to be repaid before exiting, and they could then collude with governors to profit from oracle manipulation or governance attacks. In this setting, agents may strategically bid up governance token prices or issue bribes. The governance problem now changes to incorporate collusion decision variables. The vault problem changes to decide a strategic portfolio, including a governance position and a participation level in the stablecoin and a governance bribe. And the stablecoin holder's decision becomes more strategic, also involving a strategic portfolio and participation decision and a governance bribe. And again, the anticipated decisions from one side feeds back into the decision of the others. A few takeaways so far from these models. The fundamental value to governance, which comes from cash flows, is related to the geometric sum of discounted fees in the equilibrium. If this is small relative to collateral size, then the system requires a high alpha value, or external cost to attack, to achieve incentive security. This leads to a price of anarchy, which is the extra cost to secure a decentralized system compared to a centralized one. In this case, a centralized system relies on a high alpha value to reduce the problem to the first model that lacks an attack vector. Then, given the conditions here, essentially encompassing existing stablecoin designs that aim to be fully decentralized with flexible governance, we conjecture that no long-term equilibrium for participation exists. To illustrate, we draw an analogy with a bank. If deposits at the bank are unsecure, if bank equity is worth less than 2 times, say, assets under management, then essentially no depositors will choose to participate.
Whereas capital structure models describe single-period incentives, we also want to consider multi-period setups. So we propose a tractable formulation of multi-round incentives, so separate models with a specific coupling which are iteratively solvable to find an equilibrium. So our base blockchain model, miner extractable value, MEV, is the implicit bribe for miners, and we model the success probability of these bribe incentives to fork. For the application layer model, MEV extracts the value in a stablecoin, which affects participation incentives, and participation determines MEV size. So an output of the base blockchain model is the success probability of an MEV bribe, which is the input to the application layer model. And an output of the application layer model is the level of MEV opportunities, which is the input to the base blockchain model. Well, so far we've talked a lot about participation incentives, but to address the second question of economic stability, we need models of dynamic prices. In the most closely related financial literature, an asset that is assumed stable is borrowed against collateral, with feedback effects on the liquidity of the collateral asset. With non-custodial stablecoins, the price and/or participation of the stable asset is itself endogenous. We have some stochastic models of endogenous stablecoin prices. In these models, deleveraging feedback effects lead to sub-martingale prices with collateral drawdown, and they have also characterized stable and unstable regions for stablecoins. but we present many more open questions in our paper. The framework we've developed can be used much more broadly to understand the economic security in many DeFi protocols. For example, composite stablecoins, which can resemble ETFs, automated market maker pools, and CDO squared. Also cross-chain and synthetic assets, PLFs, DEXs, and probably more. We also highlight a design gap, a full exploration of buffer designs that can cushion extreme events. Our last observation here is a conjecture that the feasible participation regions of decentralized exchanges is larger than that of stablecoins, for reasons we discuss in the paper related to the differences in economic structure. This brings us to the end. Thank you very much for listening, and feel free to ask any questions. Please note that the paper is available on archive.